rand traded softer against the dollar, really being spooked by debt problems in Europe, where we've had the dumping of emerging market assets perceived as posing higher risk. But we've been in this trading range for the longest while now, between 665 and 698 thereabouts. What did you make about the move beyond 7 yesterday?
Good morning, Alishia. Yes, I think obviously 7 is quite a psychological level, and we did reach above that briefly yesterday. But I think we are probably going to head higher again, and I think that we're on track for a move up to the 708 region as a result of all this risk aversion. We've seen obviously the safe haven assets like your gold, Swiss franc, Japanese yen, US treasuries, they're all flourishing at the moment. And as you said, it's the emerging markets, it's the equity markets that are taking a bit of a bath, and we're seeing it across the spectrum. Credit spreads are wider, volatility levels are increasing, so there's a lot of market jitters out there, and the rand is truly living up to its high beta status. It's very vulnerable in times of risk aversion, and once again it's been the underperformer.
So where we've had some saying that we could use this as a buying opportunity for the rand, yes, there are still some rand bulls alive and kicking. Safe to say that you're saying not just yet?
I think exporters could probably hold out for slightly better levels. The rand has definitely weakened considerably in a very short space of time. But until we get more clarity on the debt situation in both Europe and the States, I think nervousness is going to prevail and the rand is going to remain on the back foot. So, as you said earlier, that range up to kind of 694 has held repeatedly this year, and exporters will probably be a bit inclined to pull the trigger sooner rather than later. But I believe they could hold out for slightly better levels before the rand becomes quite oversold.
Having said that, Michael, not so long ago we were talking about a change in perceptions of risk, and with that, emerging markets coming in focus, holding vogue on their growth prospects, looking solid or more solid than developed market counterparts, and then higher rates as well, offering carry trade opportunities. So what's changed?
Well, quite frankly, I think that emerging markets have had a considerable run already since around 2009, and a lot of that good news that you mentioned, the carry trades, the growth prospects, I believe are fully discounted in a lot of these emerging markets. If anything, I think we've got to be looking for signs of a turnaround, and I think that we've seen more recently a lot of emphasis being placed on whether or not the global recovery is actually on track. And secondly, of course, what are these debt problems in Europe and the States going to mean for global liquidity? Because it could very well cause a lot of participants to actually liquidate some of those emerging market positions purely from a cash management perspective. Because if suddenly you get credit rating downgrades, your collateral is in jeopardy, and suddenly, as I say, you've got to forcibly liquidate some of those other assets to get your hands on some cash.
If we see, more stimulus coming into the system, then does, the complete reversal or the opposite of that argument that you've put to the table come to the fore?
I don't think so. I think, again, that a lot of good news is priced into these emerging markets, and we've got to start seeing, for signs that we're going to be getting exit strategies from the States, etc. And that, I think that emerging markets are probably going to struggle to beat the performances that we've seen already over the past couple of years. We've seen definite signs of slowing in a number of these regions, and of course inflationary pressures are starting to kick up. So that means that monetary tightening is going to have to come to the fore, and that will probably reduce, as you say, that liquidity injection.